There's a look at the S&P TSX Composite Index now at 25,501 points. As you can see by the number in the top right-hand side of your screen, it's up about 25% over the past 52 weeks. The year-to-date return for 2024 thus far is about 22%. So Canadian investors have done well. Our next guest says the gains will keep coming. He's Brian Belski, Chief Investment Strategist at BMO Capital Markets. He joins us from Naples, Florida today. Brian, thanks a lot for joining us. You've got a target on the S&P TSX Composite for year-end 2025 of 28,500 points. That's about 11% higher than we are right now. What gets it there? Why are you so bullish on Canadian stocks?
We do, Paul, and thank you so much for having us. Good morning, Canada. We published our 13th consecutive forecast with respect to the TSX and S&P 500 on behalf of BMO a couple of weeks ago. And clearly we've had a lot of strength here at year end. We think that strength in Canada is going to continue. And in fact, based on our numbers on a relative basis compared to the US, we think Canada is going to actually outperform the S&P 500, i.e. their neighbor to the south, principally because of kind of three factors. Number one, the catch-up trade with respect to Canada in terms of developed market equities. Number two, from a valuation perspective, we still see value here in Canada in terms of the overall index. And then number three, as we enter into what we believe is the golden age of stock picking during this broader, big bull market that we've been in really since 2009 in the United States, that favors Canada as part of that, principally because of the value and cyclicality of the overall index in the overall makeup. If you strip out the top 60 companies in Canada, Paul, it's really a small mid-cap market, which we've been very bullish on small mid-cap in North America in print for over a year now. And I think it's going to be a call, I think, that's really going to continue to bear fruit over the next 10 years.
You refer to a golden age of stock picking. That sounds like a call that riding an index is not the way to go. I mean, people who've ridden the TSX Composite Index over the past year are up close to 25%. Why do you call it a stock picker's environment?
Well, because the way that we run money at BMO, we have the very good fortune of running 8 separately managed account portfolios, and the ones that are targeted more toward Canada are up well over 25%. That's number one. Number two, if you are beholden to the index, sometimes you have to own stocks you actually don't want to own in Canada. Number three, in terms of stock picking, it really fits our overall theme with respect to normalization in terms of overall equity markets. We think we're entering into kind of this early 90s, mid 90s type environment where stock picking ran supreme, where just look at, for instance, an individual ETF on sector. Sometimes you want to own a stock and sometimes you don't want to own a stock. So yeah, indexing is important. And you should talk to your relationship manager in terms of what that means for your portfolio, but we'd rather own stocks relative to the index.
Two of the biggest components, of course, of the S&P TSX Composite Index are the financials, which have done very well for about 6 months now. They finally caught a bid after more than 2 years of bumping along sideways. And the energy stocks, which have recently caught a bid, but have bumped along sideways for most of the past 52 weeks or so. First of all, the energy stocks. Does your call on a significantly higher S&P TSX Composite Index include a higher price of West Texas Intermediate crude oil?
Great question. And our answer for energy, both in the United States and Canada, is just don't buy because Mr. Trump's saying drill, baby, drill. We don't buy because of political rhetoric. We buy because of fundamentals. And quite frankly, we've been more bullish on Canadian energy relative to U.S. energy, principally because we believe Canadian energy companies are managed much better. Number two, from a cash flow generation, they're much more consistent. And number three, we see more earnings growth there in Canada, especially the second half of 2025 from the energy side of things. With respect to financials, it seems like everyone's favorite sector to hate in Canada. We love the banks. We think that they're the best stewards of capital in North America in terms of cash. People have been too conservative there. Analysts have been way too conservative on their numbers. We think numbers are going to be very, very well into this last quarter. Remember, the banks have over-reserved because of the dreaded recession that, oh, by the way, never came to Canada. And so we think financials still, from an institutional perspective, we believe that most clients are actually underexposed, many of the banks in Canada, and have been overexposed, let's say, in insurance, especially in 2024. We see a major shift in 2025 right back into the banks again.
Okay, we've only got about 60 seconds left. The banks start reporting results tomorrow with Bank of Nova Scotia. I know you can't comment on individual names at this juncture. I think you're in a so-called quiet period, but what themes will you be watching as the big six Canadian banks roll out their fourth quarter results this week?
Theme number one, still focus on the U.S. That's where the growth is overall, especially with the proximity of the countries and the trade back and forth. Number two, wealth management. We think wealth management is going to be continue to be very strong as assets continue to come into equities and be more diversified. And I think number three, focus on these earnings being way too low. We think that financial companies are going to buy back stock and pay more dividends, and I think a lot of investors aren't expecting that.